In just under an hour to go before Finance Minister Enoch Godongwana tables his mid-term budget speech, and as we build up to that moment, we do cross back to SABC News and Nompumelelo Siziba, who's in Cape Town. Nompu, what are the economists and other analysts that you've been speaking to throughout the day? What are their expectations? Are we nearly to that time where the minister will be tabling his budget?
Yes, that's right, Diabo. Well, the economists and analysts that I've been speaking to pretty much expect that the midterm budget is not really going to change that much in terms of its tone relative to what the Finance Minister Enoch Godongwana was saying in the February budget. Of course, there may be some adjustments here and there, but the usual themes of, fiscal consolidation, tightening the belt, ensuring that state-owned enterprises use the resources that they have optimally, tough love on them and so on. That is what is expected. But some do have a view that the likes of Transnet could put some pressure on government finances, because that just doesn't seem to be taking off and coming right. And it does need more capital injection, even though it has managed to get funds from the African Development Bank and some other avenues. So we just have to wait and see whether there's going to be some leniency specifically on Transnet. But of course, market analysts, and of course we do look at the markets in the 1 o'clock hour, are keeping a very close eye on what the Finance Minister has to say around debt. How does that look? Our budget deficit and so on. So I'm joined by Reza Ismail. He's the head of bonds at Prescient Investment Management, just to give us his take on what he expects. Thank you so much, Reza, for joining us. So markets keeping a very close eye on what the Finance Minister has to say. What are the key things that they'll be looking out for?
Thanks very much for having me. Yeah, I think that's quite critical. I think that basically in terms of the broad shape of the budget, it would, as you said, would follow very, very closely in terms of both the revenue and expenditure side to the kind of projections that were done at the time of the February budget. In terms of markets, I think we're in a relatively good position as far as the bond market specifically is concerned. I think Treasury opened up with a healthy, positive balance, and I think that they've been able to very, very skillfully, deploy their switch auctions and their non-competitive auctions in a way that has been, very cash generative. So I don't think that there's any expectation, any negative expectation that there will be any further increase in the adjustments to the size of the weekly bond auctions, which is the positive development. I think there is a small outside chance that they might actually announce a reduction in the size of the weekly bond auctions, i.e. how much bonds, get up for bidding every week. And I think that could be a very, very positive development for the bond market. I think if that does, play out in that way, we could see what we refer to as a flattening of the yield curve, which is of course excellent for the cost of debt and for debt servicing costs, which has been a little bit of a thorn in the side of revenues in the past 3 or 4 fiscal windows.
So for the benefit of a small businessman, say in Soweto, who's watching this, you've said a lot of stuff, a lot of it is, your kind of language, but bottom line is you seem to be suggesting that the government or National Treasury is not going to market to borrow as much money as it has previously. And if that's the case, what are the implications of this?
I think, yeah, that's absolutely correct. So I think that they are almost running ahead of the funds that they'd hope to collect from the bond market, from their weekly auctions. So they've run ahead of that. That has opened up some leg room to essentially say, okay, now we can actually close the tap. We can actually perhaps scale down the size of the auctions. Now, what that would do for the ordinary person is that would actually cause the yield curve to compress, i.e. South Africa's borrowing costs would actually go down. That would generally translate to a little bit of rand strength. That would generally translate to lower import costs. And if we try and circle back to our man in the street, a higher rand, basically a lower import cost, that has a handle then onto inflation, and we could keep inflation a little bit better in kilter than what has been the case maybe in the past 3 or 4 fiscal windows, and that arguably leads to the man in the street having a little bit more real disposable income. So those are the things. There's many interplaying parts over here, but should it play out that way, that is very likely the course of events that we could see.
One of the important things that has been discussed, particularly quite vocally by the Reserve Bank Governor Lesitsha Kganyago, is the possibility of bringing down the inflation target. Do you think that National Treasury is going to entertain or speak to that particular issue? Why is it important for that inflation target to come down? And the reason why I ask you about National Treasury is because it is for them to instruct the Reserve Bank to lower the target, isn't it?
That's correct. I'd actually be very, very surprised if there were any very pointed kind of commentary on that particular point at the MTBPS. But I do think it is a subject that will, remain on the horizon, in the near-term horizon, and it actually might come on tables, sooner than we might anticipate. I think it's critically important. There are, of course, two opposing camps with regards to lowering that inflation band. The first one views it quite negatively, at essentially saying that by doing that, this necessarily means that rates or policy rates need to be kept sort of higher for longer, as the cliche goes, and that is basically stifling aggregate demand and is stifling the growth potential of the economy. That is one view. The second view, and we are a little bit more aligned with the second view, is to essentially say it's a little bit of short-term pain for massive asymmetric long-term gain, in the sense that if we are able to lower inflation expectations and lower that kind of band, maybe from 4.5% to 4%, that again will speak to the kind of the shape of the yield curve and to inflation expectations, which is a critical element in these sort of second round inflation effects that we know is almost like the primary driver of inflation, is almost secondary round inflation expectations. So if we can lower that, basically wage growth will come in, wage demands will be calibrated to a lower inflation, and a lower inflation expectation set begets lower inflation. So I think that is a very positive development, if at all that there will be a little bit of short-term negative effects on aggregate demand.
All right, Reza, thank you so much for your insights there. Reza Ismail, the head of bonds at Prescient Investment Management.